Greetings. We're back with a monthly commentary video for the month of February. Today is February 28th, and we'll be covering market dynamics, specifically the AI hype train, where we're at in the cycle. Does it have legs? What are some areas of caution? And then we'll look at what the Fed is thinking and what the market is expecting. So sit back, relax. I'm going to share some slides. We'll try to keep this to 15 minutes. Let's go. So I've been doing this the last few months, and I kind of like it, where we basically take inventory of the month that was. Now, I don't want to condition everybody to obsess about 1 month performance, but a lot of market movements you can weave into a narrative. And what I mean by that is the Fed certainly gets a lot of attention. Inflation gets a lot of attention. And anytime there's conflicting stories between the market and the Fed, I think you get some disruption. And I think that is showing up in some of the rate-sensitive areas. So think bonds or fixed income. Think REITs or real estate, gold. And the market action confirms some of that. So this is the month of February. Again, today's the 28th, so I'm missing tomorrow. I guess they call that a leap year, whatever that means. But essentially, bonds down, gold down, REITs down, and everything else is basically up. And leadership continues to be driven by technology, AI-themed stocks, U.S. large-cap stocks. It's nice to see emerging markets pop back. So the Chinese markets have been beaten down. They've rallied back nicely. Foreign stocks, the Dow, small cap value, cash. Most equity asset classes were up in the month of February, with the exception of real estate. And I think a lot of these rate-sensitive challenges are what I alluded to at the open. The market expected the Fed would be cutting this spring. We got a hot inflation report or two. Now the Fed is backing off. They're neutral. They're saying we're probably done hiking. We're going to pause and let it develop with the inflation data that comes in over the next couple months. So again, anytime you get these conflicting stories between market expectations and what the Fed is saying, you get disruptions, especially in the rate-sensitive asset classes, I should say. Last Thursday, we hit an all-time high, and the market, the S&P 500, closed up 2% and made an all-time high. That's a relatively rare thing, and what propelled the S&P to the all-time high was blowout earnings from AI chip maker NVIDIA. So what we've done here is we go back to 1953 all the way up to present day, and we mark days where the index closes up over 2% and makes an all-time high. And those instances are plotted on this graph in green. So you can see that when the index closes up 2%, makes an all-time high, that usually is the gateway for additional gains. And there's an old saying in investing, the trend is your friend. Of course, there are exceptions. So in the lead up to the tech crash, we got a lot of these 2% closes and all-time highs, and the market went down. However, when you look at this, that's really the exception. And I think there's a consensus out there that all-time highs are risky. And there's evidence that flies in the face of that theory. And, it can be easy to think, hey, I'm going to take some chips off the table. I want to take some profits. But markets are trend heavy, and there's trend and momentum traders that say all-time highs are not something to run away from. They're to be leaned into, and that additional highs are likely to follow. And I have a couple numbers that I want to rattle off for you just to show you how normal all-time highs are when you look at history. So back in 2021, the S&P hit 70 all-time highs. In the calendar year of 2021, 70 times the market hit all-time highs. Back in 2020, the market hit an all-time high 32 different times. In 2019, 35 different occurrences of all-time highs. And that might shock some people, but when you zoom out and understand that markets definitely want to go up over time or have gone up over time, hitting all-time highs is quite normal. Now, digging into AI, AI stocks versus non-AI stocks, the haves versus the have-nots. So what we've done here is we've looked at AI themed stocks within the S&P 500, and there's 67 of them. Okay, so that's here. And then non-AI stocks in the S&P 500, there's 433. And we're tracking average percentage change between AI-themed stocks and non-AI stocks since ChatGPT launched in the fall of 2022. And you can see there's quite the wide gap between AI, tech stocks, and non-AI stocks. I don't really have any absolute conclusion, but AI certainly has been a powerful theme over the last year or so, 14 to 15 months. What we're going to look at a little bit later, which I find thought-provoking, is where AI sits in relation to other technology themes over the last 40 years. Does AI have legs, or are we due for a pause, and is it overhyped? I don't have the answer to that question. So another way to look at this, and this is part AI, part tech, part the rate environment, but I think this paints a picture. And what I'm showing here is the S&P 500 by ETF SPY in green and a dividend ETF DVY in red since the Fed started its first rate hike. Okay. So since the Fed hiked in spring of 2022, non-dividend paying stocks or non-dividend focused indexes have performed much better than dividend paying stocks. Now, again, part of that is the top heaviness of the S&P, a lot of AI players, a lot of large technology companies driving that index higher. It makes up about 30% of the index, versus dividend payers, which tend to be older economy stocks, more stable, mature businesses. But I think this is a paradigm shift, and I've wrote about this in the past. So it's part tech heaviness of the S&P, but it's also the macro rate environment background has dramatically shifted. Dividend-centric investing made more sense in a zero rate environment where bonds yielded nothing, cash yielded nothing. Made sense to try to earn some investment income. In a 5% environment, you can argue it makes less sense. And I think the market and investors are voting with their wallet that that's the case. So you might look at the opportunity set now and say, why in the heck would I target a dividend paying stock with a 5% yield when I can sit and take zero risk in a cash money market fund and get 5%? So it's important not to anchor to one identity. You know, we come across folks that pound the table and say, hey, I'm a dividend investor, or I'm a growth investor. I'm a real estate investor. When you have such a narrow identity, you're often rigid, you're unable to change your mind, and you're basically shrinking the opportunity set of what's available out there. So be open, be willing to change your mind. Keep your identity small so you're not getting stuck with this steep penalty to pay by anchoring to dividend investing. Now, if you are going to focus on dividends, I would focus on dividend growers rather than the absolute level of the dividend yield a company is paying. Back to the AI theme, and this is perhaps the most interesting graph that we have in this month's commentary. So this is the NASDAQ index since 1980. All right, and this is the price level. This is the year. So this starts in 1980. And gives us 40 plus years of market movement post some of these major tech moments, these seminal moments. MS-DOS was an operating system. You've got the internet boom with Netscape, the search engine. You've got the iPod, the iPhone, MySpace, which really set off the social media movement. And up here in the far top right corner, you have ChatGPT, or the AI movement, which launched in the fall of 2022, still relatively fresh, about 14 months. But what I wanted to show is some of these themes, although widely known, a lot of investors chasing and shoveling money into these areas, there can be a lot of run-up post-technology launch. A lot of these themes often have legs. Also, these themes often have boom bust cycle. So anytime you're investing in emerging technology, it's not a smooth ride up. It's a volatile ride up, oftentimes very violent to the upside, which is good, but conversely violent on the downside, which can shake a lot of people, which can cause them to sell at the wrong time or, abort their long-term investment plan. So I always caution people to be mindful of position sizing, be mindful of your exposures, be mindful of risk. Don't start reaching or shoveling money into one corner of the market, because that usually does not end well. If Chat GPT and the AI theme has room to run and you have exposure, that's great. I would, again, caution not getting carried away. The other, and I even hesitate to call it a takeaway, is when you look at AI, we're still relatively early when you look at some of these other themes. Like, look at Netscape. Netscape launched in 1994, I believe. It was 6 years of pretty good performance before we got this downward crash with the tech bubble. That said, it'd be really hard to convince someone to sell here or here when they've made so much money on it. And that's the thing. People end up anchoring to some of these themes and thinking that they can't miss and they're bulletproof and they're geniuses. But markets have a habit of making people look foolish. So again, be mindful of your exposures. Don't get carried away. Have a framework for managing your position sizing and risk. Okay, so this is just a granular look at some of these themes relative to AI, which down here at the bottom axis, these are trading days. Vertical axis, NASDAQ performance after the release of each of these technologies. So when you look at this, Chat GPT, still it's relatively early, so only 300 trading days since launch. And it's tracking most closely to Netscape. So Netscape's here in purple, which really set off the internet boom, the search engine. So you can see it's tracking loosely correlated to Netscape. Now, if this journey holds, again, we're going to get some bumpy rides. We're going to get some sell-offs, but the trend is up. But there are some nasty downswings here, which you do have to have an iron stomach if you're going to own some of these themes. So if this continues, this is a promising ride for investors. And again, this is relatively early in the journey relative to some of these other themes. So it'll be interesting to see where all this ends up. And I've got some another slide that shows you there are pockets of froth, and some investors think that we've gotten carried away. The counter to that is the last graph in this graph would make the case that there are legs and there is longevity to some of these generational themes. For those that have heard me talk in the past or have read our blog, I'm very interested in sentiment. And sentiment tends to follow price. And what I mean by that, this is Google search interest for several popular themes over the past 10 years or so. So blue is Bitcoin, orange is AI, green is AI, orange is Chat GPT. What's interesting about this, when I look at Bitcoin, that sticks out to me, because if I was to overlay a Bitcoin price chart, it would be very closely correlated to this search interest line. Back in 2018, 2017, we had a run up in Bitcoin followed by a crash. 2021, another run up in Bitcoin. I believe it hit all-time highs then, followed by a crash. So sentiment tends to follow price. People get interested in something that is performing well. The flip side of that, if you're paying attention, you're in tune with human psychology and the fear of missing out and performance chasing, is you can actually create a decent trading strategy just by doing the opposite of what people are doing. So as people are euphoric about any asset class, that could be the time to exercise some caution. As people are beaten down and think an asset class is dead, that could be time to add to your position. I'm not advocating for that, but history rhymes with that sort of contrarian bent. And the way I talk about it now is, when your Uber driver is talking about how much money they've made in NVIDIA stock, let's say, that might be time to exercise some caution. When everybody is telling you how bad 2022 is and 2023 is going to be worse, that probably was a good time to start taking some risk and adding to equities. So markets tend to ebb and flow the opposite of what people are saying and feeling and interested in, if that makes sense. So consumer sentiment, investor sentiment is very much a part of our investment rules that I'm always talking about. Okay, so compliance doesn't want me to get into individual stock names, but I just wanted to point out a couple dynamics that are currently happening within the AI space. So this is a semiconductor index, basically companies that make chips of some sort. Several of these companies make AI chips, and all are in the technology sector. I think that makes sense. This is market cap in billions, so the higher the number, the bigger the company. Sales growth year over year, earnings per share growth year over year, price to earnings over the next 12 months, price to earnings ratios over the next 12 months earnings estimate. The higher the number, the more fully or richly valued a company is. And then based on this number, where that stands relative to the last 20 years. So this is a percentile ranking. So the higher the percentile, the more fully valued relative to the last 20 years. So the higher number here, the higher percentage here, the more fully valued a company is. Same thing for price to sales. The higher multiple price to sales, the more fully valued a company is, and the same thing relative to the last 20 years in percentile ranking. Now, again, I'm not going to get into the individual companies, but I will say shrinking earnings, and nosebleed levels are not a good combination. Okay, so there's several companies that are trading very stretched relative to history, and their earnings, their revenue is actually shrinking. And you might ask, how are these companies trading with such froth? How are they so stretched if their earnings are shrinking? When a new technology comes along, investors often just want to have exposure. So it's like, instead of ready, aim, fire, it's fire and then aim. They're just buying whatever because they think somebody will pay a higher price for it later, or the company will grow into the expectations. And I think Morgan Housel said it perfectly. He said, any company's value is basically cash flow times a story about tomorrow. And the story about tomorrow is the power or the potential of AI. So again, I'm not advocating buying any of these companies. I'm not advocating shunning any of these companies, but know that many of them have not so good dynamics of shrinking sales, shrinking earnings, and trading at the top end of historical ranges. So just be careful. Shifting gears to the Fed, which still is, in my opinion, the biggest game in town. So the Fed is constantly out there talking. Okay, and what this chart is, it captures the sentiment of the Fed based on their monthly speeches, which every week there's Fed governors and chairmen out there spewing narratives about what they're looking at. I personally think they talk too much, but that's a different conversation. So basically what this is when these lines are above this axis here, this zero bound, that means the Fed is biased towards raising rates, or they call it hawkish with a bias towards raising rates when this blue bar is above the zero bound. When the blue bars are close to the zero bound, either barely up or barely down, that means the Fed is neutral. They don't have an opinion on rates. They're just going to stand pat. When this line is going down, that means the Fed is slightly dovish, meaning a bias towards cutting rates. And I think this makes sense when you reconcile it over the past year or so, where in 2022, inflation raging higher, Fed was constantly battling inflation, talking about higher rates, higher for longer. That makes sense. These blue bars were above the zero bound. As inflation has subsided, the Fed has become more neutral with a bias towards cutting. We got a couple hot inflation reports the last couple months. Now the Fed is more neutral. So there's been some disconnect between market expectations and what the Fed is saying. I think that gap is still there. It's not uncommon to see some squirrely action, especially in these rate-sensitive areas like bonds, like gold, like REITs. That's what we're seeing. The stock market has basically shrugged all this off. Part of it is the AI narrative, and part of it is just it's not uncommon for good years to follow difficult years. 2022 was a historically difficult year. A lot of investors and a lot of stocks were beaten down. And as I wrote in the past, markets tend to bounce back when sentiment and price action swing to the extreme. Now we're getting some of this positive price movement. So equity markets have shrugged a lot of this off, but where it's showing up is in the rate-sensitive areas. And as soon as the Fed and market expectations align, you should start to see this smooth out. But it seems the Fed is hell-bent on staying patient, to not jumping the gun, to cutting too soon, because they don't want to reignite inflation. And know that market prices going up and Bitcoin going up and sentiment improving, all of that loosens financial conditions. Because if you're an investor and you invest $1 million in the stock market in the fourth quarter of 2022, and let's say you're up 50%, you can sell those equities and go out and buy stuff. That loosens financial conditions. So the market movement, the NVIDIA, the AI rage, one can argue that makes the Fed's job a lot harder. So they're erring on the side of caution. And again, the market was expecting rate cuts this spring. It doesn't look like that's going to happen. So Fed is in a wait-and-see mode. And, they're going to overweight these inflation reports, which are noisy anyways. But it's going to get annoying, because I think any time that you're making decisions based on noisy data, I think people can make some incorrect conclusions. So expect the next couple months to be annoying and maybe even a little volatile. Okay, so that's a wrap. I hope you enjoyed this version. I try to weave in the themes of the day and provide context and a measured look at it. If you have any questions on how we get AI exposure or how we use AI in our business, feel free to shoot me a note at insight@pureportfolios.com. Thanks a lot. I'll see you next month.